undergraduate and postgraduate students. So you're all welcome to join our growing association, and we thank you very much for your continuous support and participation in our CPDs. Today we are also streaming live from Facebook. We had an overwhelming attendance last week, and many of you are locked out. So in case any one of you is locked out, you can still catch us on Facebook group, Kenya Association of Pediatric Dentistry. This webinar will be uploaded on our website, kapd.or.ke. It will also be on YouTube and it will be on Facebook. So I think we have given enough time. So I think we can safely say we can begin this presentation. So welcome everyone. Today's topic is Kenyan taxation for the dental professional. It will be presented by Dr. Johnson Wambugu. We give him a very warm welcome. Thank you for accepting our invite to give a talk on this interesting topic. Dr. Wambugu has 15 years of clinical experience and management experience, both in public and private sector, and even the faith-based sectors. He is a general dentist in full private practice, and he has some financial background as well as healthcare management. He has a CPA, he's a certified public accountant, and has a postgraduate diploma in healthcare management. So Daktari, we welcome you, and we look forward to your wonderful presentation. Karibu.
Thank you very much, Nick, Dr. Gishu. It's really my pleasure to present to my fellow colleagues about this topic. And it actually came as a result of a conversation we had after a CPD that was held on this same platform about 3 or 4 weeks ago by my namesake, Dr. Johnson Mwangi. And I was challenged to see how we can sharpen each other by sharing knowledge that affects all of us. So I would like to begin. Jesus. Okay, I don't know, my slides are clear?
Yes, your slide is okay.
Okay. My presentation today is really about the Income Tax Act, the Kenyan Income Tax Act. So what I have done is that I have gone through the Income Tax Act and then cherry-picked all the things that I believe would affect dental practice. We shall be covering how taxes affect all of us, including associates, locums, consultants, sole proprietors, people who run their own clinics, people who are in partnerships, people whose practices are companies, and last but not least, most of us have investments, and we will just tackle a bit of how the government goes ahead and taxes that. A famous founder of the US, Benjamin Franklin, once said that in this world, nothing can be said to be certain except death and taxes. So all of us will, at some point, pay taxes, and at some point, we'll all die. And so this topic is really relevant to all of us. Now, the power to collect taxes is mandated by the Constitution. So it's a Constitution. It's actually enshrined in the Constitution. And it is the national government that collects taxes through KRA. So not the county governments. The county governments will impose other taxes, but not really affecting the dentistry as a profession. Now, an act of parliament may be imposed authorizing government to collect certain other types of taxes. That is why you see when the budget is being read in June, you'll find different taxes are introduced, others are scrapped, maybe as ways of tax incentives by the government. Now, according to the Income Tax Act, a business is defined as a trade, a profession, a vocation, an adventure, or a concern in the nature of the trade. So dentistry can actually be qualifies to be defined as a business because it is something that we use. I mean, we use our skills to generate income for ourselves. Now, the Income Tax Act, which is Cap 470, it stipulates that the tax should be charged upon income of a person, whether resident or non-resident in the year of income. In my presentation ahead, I'll explain to you what the government, when the Constitution means, but what the Act means when it says a resident person. Now, every legal person in Kenya that is, when we say legal person, we're talking about people who are recognized by the Constitution as persons. Those are companies and individual persons, natural persons. That's me and you. With a tax PIN, are required to do a tax return by the 30th of June of every succeeding year of income. So for example, 30th of June of 2020, we were that was the deadline for all of us to file our returns for 2019. Now, there has been a debate about whether if you're a dentist, maybe living in the UK, you don't earn any income in Kenya, whether you should do your returns. And when you check with KRA, it actually, as long as you have a PIN, it serves you well if you actually do your returns. So you should actually file nil returns because you did not earn an income in Kenya. So why do you need to, or why do I need to learn taxation or have some knowledge about taxation as a professional? Now, firstly, we need to be in control of our finances. Possibly you're not, there are areas in your finances where you can actually avoid tax, and I will explain what tax avoidance is. So you can actually maximize your profit by minimizing your taxes legally. So maybe there are areas where you can actually reduce your tax obligation by reducing by tax avoidance, and we will explain what that is. Now, nowadays, it is very important for you to have a tax compliance certificate in everything that you do. Some insurance companies will request you to have it for you to join them, join their panels when you're looking for a job in the public sector or even for tenders. So it is important for you to be tax compliant. It's also good to take advantage of tax cuts. Now, after the COVID pandemic hit us as a country, the government went and did some changes where to favor the population. So as of March 26th, I'm sure those people who are employed know that the highest income bracket, or when you graduate your income, it has been reduced to 25%. And these are for employees who are earning more than 47,059 shillings. That is the amounts you are earning before March 20th, 2020. This legal notice came into effect in 26th March of 2020. Now, there's also abolition of payee for employees. Any of your employees who are earning less than 24,000 per month right now should not be paying. You should not be paying taxes. Reduction of corporation tax for those of you who have dental clinics which are incorporated as companies. The current corporation tax is now 25%. Sorry, and then reduction of VAT from 16% to 14%, which will affect the cost of your supplies which are VATable. So I'm sure if you're checking any supplies that you're getting from your suppliers that have been charged with VAT, right now should be reflecting 14% and not 16%. Now, there's also the question of turnover tax, which is a tax that is usually for sole proprietors, which was changed from 3% to 1%. However, turnover tax does not affect professionals. So professionals, people in management consultancy, people in medicine, dentistry, basically professionals, we are not subject to turnover tax. But if you have a business which deals with commodities, the turnover tax is now 1% of your annual income, if your annual income is less than 5 million. Now, what is tax avoidance and what is tax evasion? These are important terminologies that we need to understand. Now, tax avoidance is a legal way of reducing your tax burden without violating tax rules. So it's actually legal. Now, examples of how you can avoid tax are capital and allowances, and I'll explain what those are as we continue. Using debt capital. So for example, when you use a loan, instead of using your own savings, and therefore you can deduct interest that you pay on that loan from your taxable income. So for example, if I go to the bank and borrow money from, let's say, KCB, and then the interest that I pay on that loan, I can actually claim it from my income, the income that I generate from my practice. But you need to be very careful with that because the loan has to be in the business name. So if, for example, if it's a company, you borrow the money in the company's name. If your practice is a company and then you borrow the money in your name and then give it to the company, which is your practice, your business can deduct the interest from its income. However, KRA will demand 30% from you of the principal. So in other words, it will be like the company is paying the loan on your behalf, and that is not allowed. So you need to be careful. When you're borrowing a loan for your business, it has to be in the name of your business. So if you operate as a business, as a sole proprietorship, in your name, and if you operate as a company, it should the loan should be in your name, in the name of the company. Now, those people who manufacture goods for export, for example, if you let's assume you manufacture something and you export it to a different country, those goods are usually zero rated, and that is it's really a tax incentive, more of a tax incentive. Now, tax evasion, on the other hand, is an illegal way of reducing your tax burden by manipulating your records so that now your tax obligation looks lower than it should be, and that is. If that's suspected, KRA can actually institute an investigation against you. Now, I'm sure most of us have done just a basic or course in accounting. And in accounting, or what you see your accountant doing is that they usually calculate your income, and then they subtract your expenses, and then they end up with something we call accounting profit, okay? Now, accounting profit is different from taxable profit because accounting profit incorporates some things that should not be taxed and others that should be included when you are calculating tax. So now, when your accountant is telling you, is calculating for you what tax you should be paying, they take your accounting profit and then they remove all those incomes that should not be taxed, and I'll explain which ones should not be taxed, and then they add back all the expenses that are usually not and should not be allowed, and then they now deduct the expenses that are allowed. Americans call non-allowable expenses non-deductibles, and then they call the allowable expenses deductibles. But that's exactly what happens. So your accounting profit and your taxable profit are two different things. They are never equal, because your accounting profit includes incomes that are not taxable, and it also includes, it does not include expenses that should not be allowed. So we need to make that distinction. So just so you understand when you're talking to your accountant about your tax obligation. Now, what are the incomes that are taxable? Okay, remember you've said that we need to know which ones are taxable and which ones are not taxable. Now, income from employment is taxable. Income from renting or occupation of immovable property is taxable. Income from agriculture, horticulture, and agroforestry is taxable. Income from withdrawal from a pension fund or provident fund by your employer. Business activities like your private practice, dividends, capital gains tax, which I'll explain later, and interest payments. These are the interest payments made to you. Pension income, royalties, goodwill. Goodwill is like when you are getting income from, let's say, a property, or let's assume that it's a property, and then it's marked up because maybe of the location, you're more likely to get more customers. That income that you get, assuming you're the landlord, that income is called goodwill and it is taxable. Another thing that is taxable is insurance compensation. So for example, if you have an accident with your vehicle and then it's written off, and then you go, and then your insurance company compensates you of the sum insured, that is actually taxable, okay? Now, if you get a loss from any of these ventures, so for example, if you get a loss in business, you cannot transfer that loss to employment, okay? So you can only recover that loss from the same source of income. And that needs to be clear. So you can only recover it from the same source of income. The other thing that we all need to know is that everybody pays payee, okay? Regardless of whether you're a locum, a consultant, an associate, a sole proprietor, everybody pays income, even partners. And we will get to that of how they pay payee. Now, what are the incomes that are not taxable? Now, foreign sources of income are not taxable, but there is a caveat. So if you are a resident of Kenya, okay, and in respect of employment, you have a permanent home, okay, in Kenya, or you have been in Kenya present for about 183 days, which is really half a year. And these 183 days, that doesn't mean it has to be consecutive. So you could probably maybe living in Uganda, and then you come to Kenya for 3 months, and you go back, then you come for another 3 months. It is deemed that you are resident of Kenya. So if you earn a foreign source of income, then that source of income is taxable, okay? But if you have a foreign source of income and you're not present in Kenya, okay, you've relocated, now that is not taxable. If you carry out cross-border activity, so for example, if you sell supplies to Uganda and Tanzania, which is really export, okay, but you are resident in Kenya, that income source is taxable. That source of income is taxable. Now, I know of Kenya that there are some dentists who work in different countries. So you find someone working in Kenya, and then they work in Uganda, Tanzania, maybe 2 months they go to Uganda, they come back like that. Perhaps you should, I don't know whether I decided to put this there and just explain about something we call double taxation agreements. Now, Kenya has taxation agreements with countries in the EAC, Canada, Zambia, France, Germany, Mauritius, India, UK, Norway, South Africa, Sweden, and therefore you're eligible for foreign tax relief. So now let me explain. So for example, if I was working in Kenya and then I also work in Zambia, what KRA does is that they take the income that I earned in Zambia, and then they take the income that I earned in Kenya, they put them together, and then they calculate what tax I would pay, okay? Then they say that amount is X. Then they calculate the amount that I only earned in Kenya, okay? And then they call that amount Y. Then they subtract X from Y, and then they will find out how much the income that I earned in Zambia, how much tax would be paid on it if I was working in Kenya, assuming I was working in Kenya. Then they go to Zambia and check how much they actually pay in taxes in Zambia. Then they take the lower of the two. So if I, for example, if I paid 50,000 in Zambia, while KRA calculates that I would have paid 100,000 if I was here, they will take the 50,000, then they will subtract it from the gross tax liability that I would have paid if I was in both countries, and then that will be my tax liability. So it makes sense if you actually work in a country where your taxation rate is actually lower than the one in Kenya. So you actually save money. So if the taxation rate in Zambia is lower than the one in Kenya, I would save money. However, if I'm working in the UK and the taxation rate there is higher than if I was working in Kenya, I would not, it doesn't make a difference because the KRA will look at which is the lower of the two. So if the amount of tax I would have paid in Kenya is lower than the UK, they will stick to the one with Kenya. And therefore you'll end up not gaining much. So it actually makes sense to, when you're working in a country, that the rate of tax is lower than it is in Kenya. Now, other sources of tax and non-taxable incomes include government bonds with more than 3 years maturity. So if you invest in government bonds and they have more than 3 years maturity, that is the interest income you earn from the government is actually non-taxable. If you have property, that means a rent, you rent property which is abroad, that is non-taxable. If you have a business that operates abroad, that is also non-taxable. If you get dividends and interest income from companies that are based abroad, so those are foreign companies and they have no residence in Kenya, that is also not taxable. If you invest in a life insurance company here, the dividend you get from there is actually non-taxable. If you do dividends from, from registered venture capitalists, that is also not taxable. And then for those of you who are waiting to inherit something, it's actually not taxable. However, if you leave property or for your children, and then the income that they are earning is, you leave it under a trust, and then so probably they're getting income every month from that trust, then your children will pay taxes. So I hope that is clear. And then also dowry is not taxable. Now, I have explained we have different categories of professionals in this forum. So we have people who run their own businesses as sole proprietors. We have people who are in partnerships, who they've partnered 2 people. The people whose practices are companies. The people who are in government and employed by other institutions, like the university. The people who are associates, so they work in people's clinics as associates. The people who are locums, who they probably work in 1 or 2 practices. And we also have consultants who probably go to different hospitals doing surgeries and all that. And then we have a mix of the above. So somebody is a sole proprietorship and has a sole proprietor, and at the same time they're employed. So this is, you're going to tackle each and every one of them. Now let's start with sole proprietors. Now these are people who run businesses in their own name. So it's registered in your name, okay? And they are not legal persons in terms of from a legal standpoint. So what that means is that if you get into trouble with your suppliers, with your employees, or probably people who you have contracts with, they would sue you, and they would not sue a company. So they would sue you as the doctor. Now the income you generate from here is taxed with other incomes. So for example, if you have a sole proprietorship, and then at the same time you have business income from something else, and at the same time you have employer. So what happens is that this sole proprietorship will have the expenses deducted from it, and then that income will be aggregated with other incomes, and then pay will be paid on that. Now, remember I said that, management, consultancy, and professional fees do not attract turnover tax as for now, because you're still going to pay payee on that. So we're not affected by turnover tax. Now, which expenses does the Act allow you to deduct from your your income, from the income that you generate? Now, all expenses that you incur from the generation of that income. So for example, the rent that you pay, the salaries that you pay your employees, the wages, stationery, water, electricity, telephone, and so on and so forth. You're also allowed to deduct medical expenses of the owner only, okay? That means only yourself, not your spouse, not your children, up to 1 million every year. That one, you're allowed to do that. You're also allowed to expenses that you will have when you contribute to a retirement scheme of up to 240,000 every year. I'm sure you people have seen this in iTax when you're filling. It shows you that you have a limit of 240,000. This is about 20,000 every month. Then there is a contribution to a registered home ownership savings plan for up to 48,000 shillings per year, which is about 4,000 shillings a month. Now, this home ownership savings plan was introduced by government a long time ago as an incentive for people to save for their homes. But it's not worked very, very well, because if you look at the number of mortgages in the country, they're very low. Most people don't take up mortgages, but the majority of the middle class is actually renting. And the people who have mortgages either are getting them from as a benefit from their employers. So this didn't work very well. So the finance bill that was just read a few weeks ago, this was discontinued. So from 2021, in January, you'll not be able to claim home ownership savings plan of 48,000. Then there's what we call owner occupier interest, which is mortgage interest relief, or up to 300,000 per year. Now, this is the mortgage interest of the place, your house, where the home where you've bought. The interest on that is an expense that you can deduct from your income. Now, this is qualified in that it has to be a mortgage that you get from a financial institution and not a SACCO. That's number one. And number two, you have to be living in that house. So you can't take a mortgage and then rent out the house and then claim mortgage interest relief. And I hope that's clear. The other thing that you are allowed to do is trade the debt as written off. So for example, if you have patients who have refused to settle their bills, and you're allowed to deduct that from your income. However, there's a caveat. That debt has to be incurred wholly and exclusively in the normal course of business. So in other words, it has to be an income. It has to be a debt that was as a result of your business activities. So you can't loan somebody money and then write that off or get off your incomes. It has to be concerning your business. The other thing is that it has to be a debt. The debt cannot be of capital in nature. So in other words, you cannot have, for example, sold land or let's say a car to somebody, then that person hasn't paid you. And then even if the asset belongs to the business, and then now you want to write that off from your books. So that is not allowed. then you must be able to demonstrate that the debt is not collectible. So I think that they say for 3 years, and then so basically maybe the debtor is bankrupt, has been declared bankrupt by a court, or is suffering from insanity. Now, provisions for bad debts are not allowable. A long time ago, when I studied accounting, we used to have what we used to call provisions for specific debts, where you'd create a small, a provision is basically setting money aside for for people who you know who are not likely to pay you. But from what I understand now, that is no longer allowed. The other thing now, this is where I was going to talk about capital allowances. This is a way in which you can actually use legally to avoid tax, okay? And I will explain, and I'll also explain where you need to be careful. Now, depreciation is different from wear and tear allowances. Depreciation is loss in value of your assets in your clinic. So for example, if you buy a dental chair for, let's say, $1 million, and then after you depreciate it so that after 10 years, probably it's only worth 100,000, that is loss in value. But there's something we call wear and tear, which the government allows you to write that off your books. Now, in dentistry, we have classifications of cavities. I'm sure people know about class 1 to class 5. Now, in taxation, they've also classified assets according to what they would qualify for allowances, wear and tear allowances. So we have class 1, 2, 3, and 4, 4 and 5. Now, I left out class 1 because I don't think it would be applicable to us, but it's usually heavy machinery and heavy equipment. Now, class 2 is the cost of your office equipment, computers, printers, and calculators. So the printers, that front office equipment that you have, you are allowed to get 30% of the cost of that, okay? And then first, for example, if the cost of your equipment is maybe worth 100,000, the front office equipment, and so on the first year, you can take 30% of that 100,000, which is 30,000, and then you write that off from your income before you pay for taxes, and that is perfectly legal. And it is done on what we call a reducing balance method. So on the second year, it would be 30% of the 70,000 that has remained. So you do that until you get to 0. For motor vehicles, it's 25%, what we call self-propelling machines, delivery vans. If you have a motorcycle for delivery in your clinic, saloon cars, hatchbacks, but it is capped at 3 million. So in other words, if you buy a Range Rover for 8 million, you can only claim 3 million. Okay, the 25% of the wear and tear allowance is only capped at 3 million. So you'll do the first year, you'll do 25% of 3 million, 25% on the second year of the remainder, like that. Now, I need to be careful when I talk about wear and tear allowances for motor vehicles, because they're very tricky to do that for a sole proprietor, because this works very well when your practice is registered as a company. And I'll explain to you why it's much, much easier, because you'll be able to claim expenses of your car and your motorcycles on your from the company's income, and therefore the vehicle should be registered on in the name of the company. So the logbook should read the practice's name. And so the reason for that is that if for example, I have a car and I use it to drive to work every day, KRA usually will, and you want to claim expenses for the fuel that you use to go to work every day, it's actually to the discretion of KRA how much you can expense from your income, because you can't really differentiate what percentage of time do you use that car to go to work, and then what time do you use it to go to the church, to the supermarket, to go to shags. So it would work better if that car was actually registered under a company's name. And I'll explain that much later, why that. Now, class 4 includes things like non-propelling machines, such as the bicycles, carpets, curtains, TVs, shelves, signboards, all those things. So even your dental chair, you should be able to claim 12.5% of the value of the chair until, and this is on reducing balance until you get to 0. So for security and alarm systems is also included in that. Now, class 5 is 20% of cost of computer software, but this is done on what we call straight line. So for example, if you buy telecommunication equipment and you buy software from your front office, and maybe it's worth maybe 50,000, you can only claim this over 5 years because you're going to do 20% of the 50,000. Then the next year it'll be 20% still of the 50,000. So like that until you get to zero. So within 5 years, you should be able to have recovered wear and tear allowances for your computer software and your telecommunication equipment. Now there's something we call loose tools. It's really not a capital allowance, but it's something I thought that I should let people know. Now, there's you are actually allowed to deduct the cost of loose tools. Those are things that depreciate very quickly over 3 years. So let me give you an example, like impression trays. Within 3 years, we find ourselves replacing impression trays, mirrors, probes, things like that. So you're actually allowed to claim a third of that cost, and you're supposed to depreciate it away within 3 years from your books, so that within 3 years we are assuming that you'll be able to claim the entire cost of what you spent on the dental instruments. Now, other expenses that are allowed for sole proprietorship is expenditure on scientific research or invention or innovation for your practice. So for example, if you engage somebody to come to your clinic to study how to make your practice more efficient, maybe to innovate and maybe design for you a software, you can actually, the expenditure that you spend on that can actually be expensed from your practice. Contribution to scientific research organization in relation to your practice. Like if you sponsor somebody to come and do a research project within your practice for the betterment of your practice, you can actually claim that. Advertising and promotion of your practice. I know we are not currently allowed very well to promote, to advertise, but this would include things like business cards, brochures, things like that. However, the cost of your signboard is not an allowable expense. This you can claim capital allowances. If I go to the previous slide, you'll see here that we've said that signboards, you're supposed to claim 12.5% of signboards until you write that from your books. So the cost, if you put a signboard outside your clinic, so for example, maybe in Gong Road, and then you put a signboard, the cost of that signboard or neon sign or billboard, you cannot claim that from your income. So that would be considered a capital expense. So the contribution for your employees to pension scheme, then you can now offset losses in your practice for up to 10 years. So if you make a loss in year 1, then another loss in year 2, then you make a profit, you make a profit, you make a loss. So in other words, even if you make consecutive losses, you can actually now offset losses you have incurred for up to 10 years. Legal fees are also allowable, but not all. I'll explain which ones are not. So the fees that you get from acquiring leases, preparation of staff contracts, collecting bad debts, so you engage a debt collector, and stamp duty, those ones are allowable. Then preliminary expenses as you start your practice, such as rent, water, and electricity are also allowable. Now, the other interest charged on loans. So if you're starting your business and then you have a loan, that interest that you pay, not the principal, but the interest, and the loan is actually used in your business, not out of your business, is allowable. Bank charges and finance charges are allowable. Staff costs, we said salaries, wages. If you do a Christmas party, lunches, redundancy costs, those are allowable. If you put your money in a foreign currency account and then maybe there's a devaluation of the shilling and then you lose money, that is also, that exchange loss that you suffer from is an allowable expense. Donations made to charitable trusts, disaster, poverty reduction, and religion, those ones are allowable. Expenditure on projects that benefit the community. So for example, if you're doing outreach camps, the expense that you incur in that outreach camp is actually an allowable expense. Discounts that you give to your clients are an allowable expense. Audit and bookkeeping fees, the fees that you pay your accountant, the professional indemnity fees that you pay your insurance company, and the cost of insuring your clinic is also an allowable expense. Let me just go over. And then the last one here is trading losses. That is where we dispose assets at a lower fee than the written down value. So for example, if you have a dental chair, then maybe the value according to the books. So the written down value is a value that has been, how much you bought it for and how much it's depreciated to, okay? And then, so maybe it's now, you bought it for $1 million and now it's 500,000. And then you sell it for 300,000. So you have a loss of 200,000. That loss of when you dispose your asset is actually an allowable expense. So you can actually claim that against your income. Now, what are the non-allowable expenses? These are the expenses that should not be deducted from your incomes. So if you remember from what we explained before, these are expenses. If your accountant is working from accounting profit, working backwards, these are the expenses that they add back. Okay? Or if they're doing them, if it's starting from incomes going downwards, these are the expenses that they will not include. Okay, so these are expenses that are not incurred in generation of an income. Okay, so any expense outside your business is not allowable. Capital expenditure. So if you buy a dental chair, okay, that is a capital expenditure. So that is not an allowable expense. So the other one you should claim wear and tear allowances. The ones that I've explained just previously. Depreciation and impairment of an asset. So depreciation is not allowed, as I explained. What you claim is wear and tear allowances. If your chair or some piece of equipment in your office is impaired. Impaired means maybe you cannot repair it. It's now dead and you can't repair it, or it's been damaged in some way. That is not an allowable expense. All provisions of every kind, money that you set aside in case of an expense is not allowable. Non-trade bad debts written off are not an allowable expense. Private expenses like motor vehicle expenses on a single car. Now, this is what I was explaining, that it would make more sense if your car would be in the name of the practice and not in your name, because here, if the vehicle is in your name, you are you'd have to prove how much time you spend on using that car for your in your business, in your clinic. If you have two cars and one is dedicated for maybe for deliveries, maybe going to the lab, maybe it's a motorcycle, that one is fine, but this one you'd have to. I consulted someone at KRA and they were saying it's actually what they say, they call it officers, it's up to what they call of the officer's discretion. So it's up to the KRA to decide how much they would allow. So it makes actually more sense to have your car registered in your practice's name. And therefore, you can claim repairs in the company's name. You can claim insurance for that car in the company's name. So that is much better. Now, if you make any drawings from your practice, so for example, you take cash for your own personal use, that is not an allowable expense. Income tax paid or any other tax paid is not an allowable expense. So because that is tax that should be paid. Now, loss on expense recoverable under a contract of insurance. So for example, if you, God forbid, your clinic burns down, or maybe something goes wrong and it's something that you had insured, you cannot claim that loss because you're already going to be compensated by insurance. So that is not an allowable expense. The cost of purchasing a fixed asset that qualifies for a capital allowances, like I explained here for the dental chair, you would actually claim wear and tear allowances. Entertainment expenses are not allowed. Legal expenses which are not allowed are court fines or penalties. Cost of acquiring a loan is not an allowable expense. Cost of defending yourself when you're in breach of a contract. And that is why you actually need malpractice insurance, because if you have to go to court and engage a lawyer and things like that, that expense, you cannot expense it from your business. So you'd have, that is why malpractice insurance is very important in private practice, or for everyone who's in practice. Conveyancing fees, the fees you pay your lawyer, maybe when you're transacting in a property, is not an allowable expense. The cost of registering a trademark, a patent, and copyright is not allowable expense. The cost of preparing a trade contract is not an allowable expense. The cost of registering your business is not allowable, which is surprising, and even transforming it. So if, for example, if you decide to change your practice into a company, it's actually not an allowable expense. Now, what is interesting is that before June of this year, you could actually expense the fees that you pay to a professional or trade association. So the money that you pay to, let me say, Kenya Association of Pediatric Dentists, Kenya Medical Association, Kenya Dental Association, before those subscriptions, you could actually deduct them from your incomes. Now, as at this, from beginning this month, you can actually do that, not do that. The finance bill has changed. And this is very interesting. So you can actually not deduct that from your income. So anybody who paid their subscription fees before January, before June of that 30th of June this year, for this year it will be when you're doing your returns for this year it will be allowed. But now anybody who paid after July of 2020, it will not be allowed going forward. Now partnerships are the only when you talk about sole proprietorships, partnerships, and companies. Partnerships per se do not pay taxes, okay? The taxes are actually paid by the partners themselves. So sole proprietors will pay the taxes, companies will pay taxes, partnerships don't, okay? So if I'm in partnership with a doctor, and what happens is that you have something called a partnership deed, which stipulates how we should share profits, and I should say their end losses. So what happens is that partnerships are not legal entities as far as tax law is concerned. So it's just like a sole proprietorship. But in this case, partnerships don't pay taxes. It is the partners themselves that pay the taxes. So partnerships are business relationships existing between two or more persons carrying out a business with a deal of making a profit. They are governed by a partnership deed, which decides how you share the profits. So each partner will be taxed at his or her share of profit. So for example, if our partnership, at the end of the year, we have maybe made $1 million and our expenses were, let's say, 200,000. So our partnership profit is 800,000. So that 800,000, let's assume you are sharing it 50-50. So my 400,000 and my partner will have 400,000. Now for that 400,000 is what is subjected to pay as you earn. And so the partnership will not pay the tax, it is you who will pay the tax. So the total taxable income is graduated as per the income tax guidelines, and then pay is paid on that. And all the provisions on the income tax, so all the expenses that I explained are also apply to partnerships, but I will highlight a few that are a bit different. So when your accountant is doing your accounts as a partnership, they can expense the allowable expenses they can do are medical expenses of up to 1 million for each of you, okay? But it is for the partner only, not for the partner's dependent or spouse. So it is for the partner only, your medical expenses. That is why it's important to have medical insurance. Now, the contribution of the home ownership savings plan of up to 48,000 per annum. Now, you remember I said that from 2021 it will not be allowable because as from the finance bill of which was read last month, this was changed. Your contribution to a registered individual retirement scheme of up to for 240,000, that's about 20,000 every month, is allowable. Owner occupier interest mortgage rate of 300,000 per annum, that's about 25,000 shillings per annum. So the interest you pay on your mortgage for up to 300,000 per year is an allowable expense. But remember I told you the caveat is that you have to be living in that house, and this is a mortgage that you have gotten from a bank, from a financial institution, and not a SACCO. Okay, so if you get it from KMA SACCO, you cannot claim it here. But if you get it from a financial institution, you can claim it here. Bad debts written off, and remember I explained to you the criteria of what qualifies for you to be able to claim that. Revenue expenses that you incurred in the generation of income, those are salaries, electricity, water, and rent. Those are allowable expenses. Capital allowances, which I've explained. A foreign exchange loss, is an allowable expense. Now, which are the non-allowable expense? So when your accountant is calculating, they will not subtract the salaries that they paid to the partners, because we want to achieve, what we want to do is that to get is how much the partnership made. And then we're going to subtract, then we are going to share out that between the two partners so that they can each pay tax on what they made. Okay, so this is not an allowable expense. Interest paid on partner capital. Partner capital is now, if each capital loans the partnership capital and they're getting interest on that, that is not an allowable expense. Commission paid to partners is also not an allowable expense. So if you're getting any commissions from the partnership for any business that you bring in, that is not an allowable expense. Goodwill written off. Personal costs like drawings. I explained before what drawings are. Taxes like VAT, income tax. So if you're doing businesses that attract VAT, it is best advised not to mix it up with your practice. You'd rather register another business and then have that business be registered for VAT, because it will become messy. Cost of non-current assets like motor vehicles, dental equipment is not an allowable expense. Cost of breach of contract, general bad debts, and any provision for bad debts are not an allowable expense. And then all the other allowable expenses that I have explained are also not allowable expenses. Now, some dentists have registered their practices as companies, and from my assessment, I think this is the way to go, because there are numerous advantages of having your practice registered as a company than the others, because you're able, and I'll explain to you as we continue why. Because now, number one, companies are legal persons. They can own assets in their name, they can be sued or be sued. So if you, for example, have a company and then you are having maybe an employee dispute with somebody who they've employed, then they decide to go to court, the employee would actually sue the company, not you, because it's the company that has employed that person. These companies can own assets in their name, they can be sued, they can sue. So companies are legal persons. So the law recognizes companies are legal persons and also natural persons, individuals, as legal persons. Companies also have a separate capacity, and the profits of the company are taxed from its own name and not in the name of the owners. So now what happens is that if you own a company, you become an employee of the company, or what we call it, you can be director or an employee. So what you do is that the company pays you a salary, and then you pay on that salary. Then the company will also pay what they call corporation tax, which is at 25% now, down from 30%. So now the company will pay corporation tax of 25%, and then you will pay as an employee of the company. If the company at the end of the year decides they're going to declare a dividend and pay its directors dividends, that is going to be taxed at 5%, which I'll cover later, and which is a final withholding tax. Now, when the company, when the practice has other income, like rent, selling my supplies and all that, those incomes will be taxed as an aggregate. So what will happen is that the income from the practice, the income from rent, the income from these are things, they are aggregated together, and then the company pays taxes on them. Now, the same rules of the allowable and disallowable expenses I've explained before also apply to companies. Now, the key differences between sole proprietorships and partnerships is that now in our companies, I've explained, the salaries and allowances paid to directors are allowable expenses. Remember, in partnerships, I said they're not allowable because in partnerships, the partnership does not pay taxes. So it is the partners who pay the taxes. Now, for companies, it is the company will pay taxes, and then the directors will also pay taxes. So the directors will then pay taxes on the salaries and allowances they receive, and then the shareholders, many times it's still the same dentists who are shareholders, they will receive a dividend income from the company if they decide to declare an income. Transactions between the company and the directors are treated as business expenses for tax purposes, okay? All incomes by the company are aggregated together with business income for tax purposes. Hence, you can charge expenses earned in earning those incomes. So that is what I was saying. So for example, if you have a car and then that car is registered in, let's call it Gong Road Dental Practice. So the logbook reads Gong Road Dental Practice. So that car, the fuel that you fuel, you can claim it from the company, because it's now would be a taxable, it would be a benefit to you as an employee of the car company. Any repairs you do on that car will be paid by the company. The insurance that you pay on that car will be paid by the company. And so it makes much more sense to do that. Now, for tax purposes, it makes much more sense for dental practice to operate as a company for the following reasons. I explained liability, litigation from employees and suppliers. It's easier to differentiate between personal expenses from business expenses. You can deduct expenses such as training, travel, and insurance since you are an employee of the company. So now you're an employee of your company. So if you go for a conference, your company pays for that conference. If you decide to do some training, the company pays for that training. So you can claim those expenses from the company. Now, one thing I need to highlight is that if the company car is in your company name, when you're doing your taxes, you'll have to declare that as a taxable benefit. And I'll come to that later as we talk about employed persons. As from 2015, the Companies Act changed. Now you can form a company as a single director. So you can actually form a company alone. Many years ago, when I studied accounting, I remember we used to say for private companies, I think the minimum used to be 2 people. Now the Companies Act changed. Now you can actually form a company alone. So you're the single shareholder. So it makes registering a company much easier. And as I've explained, you still need malpractice insurance. As if you are to fall into trouble, it is the patient who still sue you, not the company, because now it is you, the doctor, who has rendered the service and not the company. Let's talk about investments for a bit, because many of us have investments in SACCOs and rental properties. Now, the dividends you get from SACCOs are charged at 5% and also from companies. So, for example, if you have invested in a stock exchange and then you're getting dividends, let's say from Safaricom, the dividends that you earn are charged 5%, and this is a final tax. So, for example, if my dividend is 100,000, 5,000 of that is tax, the 95,000 is mine. So that is final. However, if you've invested as a company, it is not a final tax. Okay, and I will explain that later. So the companies are usually are charged differently, and I think it's 15%, and it's not a final tax. You still have to aggregate it with the other incomes. If you have invested in companies that are non-resident, then you get any dividends, it is charged at 10%, which is a final tax. Now, dividends from cooperative societies, now these are not SACCOs. So, for example, if you do agricultural income and then maybe you're a member of, for say, Kenya Farmers SACCO, okay? Those are cooperative societies. The dividend that you earn there, it is charged at 15%, which is a withholding tax, and is not a final tax. So when the money that you get, you will aggregate it to the other incomes, employment, business, then that's when you'll charge tax. Rental income for a resident is charged at 10% of gross rent. Now this changed. I remember a long time ago, they used to charge at 20% of, you take your rental income and then you'd remove expenses, and then they used to charge 20%. But the government realized that there was a lot of tax avoidance. So what now happens is that if you have a rental property, the tax is charged at 10% of your gross rent as a final tax. So if you earn, let's say, if you have a house, maybe you earn 100,000 from that, the gross rent is 100,000. So 10,000 of that is tax. So you don't claim expenses from that. The threshold for this, if I'm not wrong, is 12,000 shillings of rent up to 833,000 shillings. So in other words, if you earn an annual rent of 144,000 per year to up to 10 million, you qualify for 10% of your gross rent for you to charge tax on 10% of your rent. 10% of your rent. Beyond that, I think now that you start qualifying for VAT. But for most of us who have houses and things that you rent out, it is 10% of your gross rent as a final tax. Then in 2015, something called capital gains tax came into effect. And this is tax on sale of properties like land and buildings. Now it is charged at 5% for municipal areas and 3% for rural areas. Now let me explain. So for example, if I buy land, and before I forget, the threshold for capital gains tax is 3 million currently. So if you buy land for, maybe I bought the land for 500,000 and I sell it for $1 million, the threshold has not been met, so you don't pay capital gains tax. However, if you sell the land for, let's assume the land is within Nairobi, which is a municipal area, maybe I bought it for 3 million and then I sell it for 5 million, capital gains tax what will happen is that they will say 5 million less the 3 million. So the profit you've made is, the gain you've made is 2 million. Then they will subtract the cost that you've incurred in doing that transaction, okay? And then they will calculate 5% of that. If the land is in shags, those rural areas, maybe somewhere deep in Siaya, it will attract 3%. So, but the threshold still is 3 million. So if, for example, you sell the land at 6 million and then you sell it, you had bought it for 3 million, they will be 3 million of your gain. They tax it at 3%, then they subtract the cost of acquisition. So you subtract the cost of acquisition and then they charge 3% of that. Now, then the interest income, that is the amount you receive when you lend money to institutions, such as financial, building societies, central bank, is subject to a final tax of 15%. But you remember I said that for bonds which have a maturity of more than 3 years, the taxable, that's a non-taxable income. However, if your company receives interest income of the 15%, so in other words, you've done this investment in the name of your company, it is not a final, the tax is not final and it will be aggregated with other incomes. So if your practice has invested in a financial institution, then that interest that you get, the person paying the interest will withhold 15%, but that is not a final tax. It will still be aggregated with the other incomes of the company, and then that will be now taxed. Now let's talk about people who are employed. Income is assessed for taxation. It's from services rendered outside or inside Kenya by a resident person. Employers must remit pay as you earn by the 9th of the month. Today I learned something very interesting, that KRA has now changed it, has tweaked the system, if so to speak, that if, for example, my practice, I have 3 employees and there is no chance that I will increase the number of employees, you can actually pay as you earn before the deadline. Before you would have to wait for the month to elapse. Now you can pay in advance. So that has changed. But anyway, the deadline is usually the 9th of the month for those of you who have employees. After COVID happened, the tax brackets changed. So that is the tax bands, how they're calculated. So for example, if I earn a gross salary of, let's give a hypothetical example, let's say 100,000, the first 24,000 will be taxed at 10%. Then the next 16,666 will be taxed at 15%. Then the next 16,666 will be taxed at 20%. Then the final balance of, after you've deducted this, will be taxed at 25%. So if you really aggregate this, it's not, the pay is not really exactly 25%, it's actually slightly less, but that is how taxation is calculated. Then other incomes and allowances that are taxable are house, medical, school fees, mileage, entertainment, special duty, transport are taxable. Maybe one thing I can mention is that for things like school fees, if you're employed and then your employer pays school fees on your behalf, it is not a taxable benefit to you for as long as your employer does not claim that as a business expense on their side. So if they decide, if your employer decides that they are going to subtract school fees from the school fees they pay for Dr. So-and-so for their children on their side, then now it will be required for you to also pay tax on it. But if they decide they not expense it as a expense, therefore they will not reduce their income, then it will be tax-free on your side. Just give me a second. I'm having a little bit of challenge with my mouse. Okay. Overtime and bonuses to low-income employees. So if your employees who you earn less than 24,000 in your practice, if they do any overtime work or bonuses, they're actually exempted from tax. They should not be paying any taxes on that. I'm sorry, my slide is a bit busy, but stay with me. We're almost done. Personal tax relief, which is actually something that is applicable to everyone, has been increased from 16,000. If you did your returns in June, I'm sure you saw this figure of 16,000, which was about 1,408 per month. Now, after COVID happened, it is now to 28,800 per month. So it's about 2,400 shillings every month of tax relief. The medical benefits to employees are not taxable. So if you pay insurance for your employees, it's not taxable. However, there's a caveat. That medical scheme should be registered as number one. And number two, that medical scheme should be non-discriminatory. That means it is for everybody in your practice, okay? Not just for the directors, the doctors, then you leave out the assistants and the nurses. If that's the case, then it's not discriminatory and therefore it's a taxable benefit. But if it is non-discriminatory, that everybody is equal and getting the same, getting the access to a medical scheme, then it's a non-taxable benefit. And the other thing is also the benefit should only be paid when sick. So in other words, it is when you go to hospital and then the hospital is paid after you have been treated, then it's a non-taxable benefit. However, if you're getting reimbursed for medical expenses that you earn, that you incur after you have after you have gotten sick, or you've been given an allowance to cover that, now that becomes a taxable benefit. Remember what I've explained about school fees? They're not taxable as long as your employer does not claim it as an expense. Housing benefit right now, so if you're housed by your employer, maybe let's say you work in Kenyatta and then you are housed, the housing benefit is usually taxed at 15% of house rent. I know essential employees usually, the government usually is very lenient because now it's tied to your work. A doctor has to live at their workplace. So many times you don't find that doctors getting taxed by that because of that, because you're living in the hospital premises by the nature of your work. So that's not really a benefit. However, if your rent is being paid for, let's say by the company or your practice, the housing benefit is actually taxed at 15% of the house rent. So if the house rent may be 100,000, 15% of that is 15,000, and that 15,000 is the tax due. Car benefit is at 25% of the value of the car. Remember I said if the car now is registered in the company's name, the 25% of the value of the car is your taxable benefit. Per diems of Kenya shillings 2,000 per day are not taxable. I was recently involved in the rollout of the oral cancer manual, and I remember I kept wondering why government is stuck with per diems of 2,000 shillings per day. And it's because in the Income Tax Act, after 2,000, the per diems of 2,000 shillings per day are not taxable. But you also have to prove that the per diem is this money that was given to you and for use out of your workplace. So for example, if you have employees in your practice and you're giving them per diem, you have to prove that those incomes, that per diem was used, for example, for this guy to go to Nakuru to do some work for you there for some days. So you can't just give per diem and then the person is staying within your practice. Meals that you give to low-income earners of 40,000 per year are not taxable. So that's about 4,000 shillings a month are not taxable. Training costs that you pay for your employees in connection to the service you render are not taxable. Telephone benefit is taxed at 30 shillings per annum. So if you're receiving or giving airtime to your employees, let's say you're receiving as an employee or you're giving it to your employees, the taxable benefit is taxed at 30% of the cost of the telephone. The furniture benefit is usually given at 12%. So if in that house that you live, they have provided furniture for you, KRA takes the value of the furniture, then they take 12% of that. And then now that is what is calculated as tax. Grocery bills that you pay for your employees or are not taxable up to 36,000 shillings per annum. So for example, if your assistants, you give them 3,000 shillings every month for their groceries and all that, that is not taxable. However, remember, you need to be careful that even as you give these non-taxable benefits, which is the meals and all that, you need to make sure that you don't cross the threshold for taxation. Employee benefits in kind. So for example, if you do free dental work for your patients, those are benefits in kind. Those are not taxed up to 36,000 shillings every month. Beyond that, your staff have to pay taxes for that. Now, fringe benefits are enjoyed by people. I know, like, for example, in some institutions, you have, let's take NH as a hypothetical example, giving you a loan at maybe 5%, while the market rate is 10%. If you went to the bank and got the same loan, you'll probably get it at 10%. So fringe benefit is the difference in the cost or how much money you are saving from the difference in the interest rates. So just to give an example, so for example, if you, let's say, get a loan of 100,000 from your employer, and then the interest rate that you get from your employer is 5%. So ideally, you should be paying interest of 5,000. And then if you get the same loan out there, it should be at 10%. So what they do, they will calculate the difference of the interest that you have paid out there and the one that you're paying your employer. When they get that amount of money, they're going to tax it at the corporation rate tax. So that's the tax that companies pay. So currently it's 25%. Now, for employed persons, when you look at your payslip, you find your contribution to NSSF is a deduction, to NHIF, contribution to a registered pension scheme, which is usually the lower of either the actual amount you paid, 30% of your employment income, or up to a maximum of 240,000 shillings per year. I'm sure you've seen this on your iTax as you fill it. So employers' contribution to a registered home ownership savings plan for up to 14,000 shillings a year. I explained before that this is not allowed after 2021 January after the previous budget, the red budget was read. Employee contribution to professional associations was allowable, but remember I said that after July, after 1st of July this year, this is now not allowable. It's not an allowable expense. So the expenses, the associations you pay to KAPD, to KDA, used to be allowable, but after 1st of July 2020, it's no longer allowable expense. Owner-occupier interest, which is mortgage interest relief. So the interest that you pay on your mortgage up to 300,000 per year is not allowable. It's an allowable expense, and it's only valid for one house. You have to be living in the house, and it has to be a mortgage from a financial institution and not a SACCO. Now, let's talk about locums, consultants, and part-time employees. Now, the income that you get from a locum usually is subjected to 5% withholding tax, and this is not a final tax. There was a debate for a long time because remember, many years ago, there was a misconception that withholding taxes are final taxes, but it is not. So the other thing is that if you're subject to other factors, if you are maybe working there and at the same time you have normal work routines, normal working hours, you go for leave sometimes, you have some responsibilities, you should not be paying withholding tax. You should be paying pay as you earn. Therefore, because it's important for you when you're engaging a private clinic or a private practice to negotiate a salary that to be able to cover the payee, because you sort of paying the payee yourself. So instead of, because what is to happen is that because of that misconception, people would get into employment with a practice, then they pay only the 5% withholding tax. What they don't know is that at the end of the year, they have to account for the remaining 25%. The best approach is to actually negotiate a higher salary, then you have your employer pay as you earn, and then it makes your work much, much easier and for you. Your income as a locum, let's assume you're employed somewhere else, maybe you're in government or you're somewhere else, is usually aggregated with other incomes and subjected to taxes. You can deduct allowable expenses, the ones we have explained, according to the Income Tax Act, on the total taxable income, but you have to be able to prove that they were incurred in generating the income. So the expenses that you incur for generating the income as a locum or a part-time employee. Now we're at the end of our presentation, but it is important for you to note that dentists who are in employment and engage in private part-time practice as locums or consultants, the extra income is deemed to be professional consultant fees or business income, which is subject to tax and added to the employment income for the purposes of tax. So the payer, who is the owner of the practice or maybe the hospital you're working in, they're supposed to withhold 5% as an advance tax. And usually when you go to iTax, you'll find that those tax credits are usually given there, and they're remitted by every 20th of the next month. The threshold for deducting withholding tax is 24,000 shillings. So for example, if I do work in a hospital and I am a consultant and I make 20,000 shillings, they are not supposed to withhold any tax because they have not met the threshold. The threshold is 24,000 shillings. All resident individuals are entitled to a personal relief of Kenya shillings 16,896, and now it has been revised. I think I mentioned that before, to 28,800 per annum. My last point is that you're also entitled to an insurance relief on premiums you paid for you, your spouse, or your children up to a lower of either 15% of the premium that you pay, but up to Kenya shillings 5,000 every month. So that means about 60,000 every month of for medical insurance, life insurance, educational policies for not less than 10 years. So those are incomes that you can, those are expenses that you can actually deduct from your income. So with that, I have come to the end of my presentation. I hope I have not lost anybody. My intention was just to answer a few questions that I usually get once in a while from people who consult me. Also for you to be able to engage your lawyer, your accountant more effectively when you're filing your returns, because now you'll be able to engage them from a point of knowledge. I'm sure KAPD will circulate the presentation for your own reference. And thank you very much.
Thank you very much, Dr. Wambugu. That was very, quite overwhelming. But yes, I think we have come to appreciate the need to look at our financial situation, especially the need to have an accountant who can explain to us all these nitty-gritties that we take for granted. So thank you very much. I think we'll go now to the question and answer section. That has been very informative. So the first question, someone is asking, could you kindly comment on withholding tax, which I think you have, and what is the process of amending from a partnership to a company?
So withholding tax is a tax that is just what it says, is taken in advance, withheld by the payer. And we have two types. It can either be a final tax, meaning that no other taxes will be deducted from that amount. So for example, if I make let me just give an example. So if it's an income, for example, from a practice, and maybe I'm working for a practice, if they're supposed to withhold 5% of that, then KRA will know that an income of 200,000 has been earned. So they will be waiting for you to account for the balance of 25%. So in that case, it's not a final tax. When it's a final tax, it means that no other taxes are required of you. So for example, if you receive a dividend from a company, or for example, let's say KMA Sacco, you get dividends, you'll find that KMA will withhold 5% of your dividend. And then at the end of the year, you do not need to pay any other tax. It means it is a final tax. Okay. I hope I've answered. The next question was about changing from
a partnership to a company.
Yes. So what happens is, so what happens is that you need to have a lawyer draft for you something called a memorandum of understanding. A memorandum of association, and what we call articles of association. Then those are the documents that now you are lodged by the registrar of companies. That's how you change it to a company. Yeah.
Okay, another follow-up to the withholding tax.
Yes.
So you've earned your income. 5% has been remitted. For example, let's say it's a hospital. So the 25%. So these are the questions. For the 25%, do you remit it yourself personally? Do you remit it at the end of the month? Do you first deduct like your expenses, and then now remit the balance? What happens to the balance? What happens to the 25%?
So what happens is that the reason why they're giving you that 25% is that to allow you to deduct your expenses. And once you deduct your expenses, then now you remit the difference. Now, most people find it easier to do it at the end of the year. So when you're doing your returns, because some expenses might come on a month, they're erratic. So this month you may have, this month you may not have, like that. So some people prefer just to do it. They aggregate their incomes for the entire year, then they deduct the expenses. When you go to iTax, you find that it's the tax has already been put in iTax, the withholding tax. Then now once you deduct expenses, it's when now you pay the difference.
Someone's asking, can one change current vehicle ownership from self to the company? And what's the process go about that?
Yes, that's very easy. You just need to, first of all, the company must be registered, okay? Then it has, then what you do is that now you create a NTSA account for the company. And then now you transfer the car to the NTSA using the NTSA portal. And then now the company, the logbook will read in the company's name.
And what happens to institutions that do not remit taxes for your employees, whether it's withholding or even payee?
So the liability is on the employer, not on you, because it is by law they're supposed to remit on your behalf.
Okay. There's a question: if I'm salaried and earning income from the government salary and from your practice, should I pay 25% payee or just withholding tax of 5% and then declare the remainder 20% or 25% at the end of the day? I think that's what you had covered.
Yes. So if you are earning an employer salary from the government is already paying the payee. Okay. But now for your business, now you'll have your income, then you subtract your allowable expenses, then that now will be added together with your so you'll pay payee on that income also. One thing people need to understand is that everybody pays payee, regardless of whether you're a sole proprietor, a locum, a consultant. Everyone pays payee. So but the 5% I'm talking about is within when you aggregate your payee, that 5% will be considered as what they call an advance tax. So to answer the question is that they would pay, they would, from their business, from their practice income, they subtract the allowable expenses, and then that is charged tax.
Especially with regards to people working in partnerships, associates, and maybe the young dentists planning on opening up their own practices, would you kindly elaborate the advantages of maybe a limited liability partnership over a limited liability company?
So limited liability companies mean exactly that, in that if you if you were to get sued or get into a disagreement, they can actually sue the partnership. Unlike the partnerships that I talked about before, where they're not legal persons. Now, limited liability partnerships have that protection. But don't forget that limited liability partnerships, it is still the partners who pay the taxes, not the company. So when you start apportioning some expenses like training and motor vehicle, it becomes difficult because now it is the partners who pay the taxes. Companies will be much better for dentists because now you can charge the expenses on the company, and for as long as now you are working as an employee of the company.
Can you give us your comment on how research grants are taxed?
Now, research grants are not taxed. I probably confuse people. What I meant is, if you have somebody in your practice doing a research, and then you are the one paying for that service. So maybe somebody is doing a research, for example, for a project, and that project is to improve your business or solve something to do with your business. You are allowed to the expenses that you get from you incur from that and subtract that from income. So that's what I meant. Not that you receiving a research grant.
For those in private practice, those who have clinics, stuff like Christmas bonus, lunches that you buy for the employees, are those allowable taxes? Or
yes, they are. Yes, they are. Yes.
What's the best way of handling book value of zero on equipment? Do you sell it?
So if the book value is zero and then you sell it, you're going to make a profit on disposal. Okay? That profit on disposal is actually a taxable income, to be handled as income, because you have actually made a profit. But if there's a reverse, if you sell it as a loss, that's an allowable expense. So if you sell it, it's fine. It's income to you, but it will be, when you're calculating incomes up there with your patient revenues, you'll include their profit from disposal of asset.
And with regards to wear and tear, how prudent is it to enter items like impression trays or mouth mirrors as capital expenses?
So it's not a capital expense. Remember I said it's classified as loose tools, okay? Mm-hmm. So those tools are tools that wear away quite fast, okay? And they are allowed for wear and tear allowances. You can claim up to a third, 33% of it. And if I'm not wrong, it should be over 3 years. So that is allowed. It's perfectly within the law to do that for tools, things that get finished very fast. Equipment in your clinic that gets finished. We're talking about a handpiece, something that you have to replace in 3 years, things like that.
For those in private practice as well, can a director withdraw himself or herself from the payroll, that is from paying the payer, and start paying themselves a commission? Can you move from salary to locum? Is that advisable? What issues can it bring in the future?
So is this for somebody who is working for a company or owns the company?
Okay, or let's say owns the clinic.
So if you own the clinic, it depends now. Are you a sole proprietor or are you a company? If you're a company, if you're operating as a company, then you are an employee of the company. So you would be paying pay as you earn, and then the company would be paying corporation tax. And just to say, there is another reason why companies do very well. A good example, a way of operating as a dentist is that if, for example, let's say your practice income is $1 million, you can pay yourself a salary of maybe 800,000. So what will happen? That 800,000 will be amenable to pay, and then for the profit that you make, which is now small, will be for corporation tax, which is much better than operating as a sole proprietor, because as a sole proprietor now you're not able, there's some expenses that you cannot put in, while for a company you can remove all those expenses much easier. So it makes much more sense to operate as a company.
So is it better to, because at one point you had said it's better to pay yourself a higher salary,
Yes,
to avoid tax?
Yes.
How does that work?
So what I'm saying is this: if you're a sole proprietor, there are certain expenses that you cannot. That I explained, like things like conferences, things like medical, car expenses. There's something that you cannot be able to expense from your sole proprietorship, because you have to prove to KRA that this expense was incurred solely in the generation of income. Now, so in other words, your taxable income will end up being so much, and then all that when the allowable expenses are not much, so you end up having to pay on this big lump sum. But as a company, on the long run, there are expenses that you can put in there to reduce your company profit, and then one of those expenses is your own salary, so which you will pay on. So your company's profit will end up being small. So your corporation tax is not much. So what you've done is that you've transferred your tax obligation from a corporation tax to now pay as you earn. So it makes much more sense if you operate as a company.
Okay. And is there a limit on the number of years a car should be in order before you transfer it to a company? Does the 8-year importation rule allow?
No, it doesn't matter. What matters is that at the time of making it a company car, you should have had it valued by a registered valuer. That's number one. Number two, you need to maintain something called a schedule for wear and tear. Remember what I was saying? The wear and tear allowance every year until you have it, the value comes down to zero. So you need to maintain that schedule every year. So it doesn't matter whether it's a new car, an old car. What matters is that you have the value of the car when you introduce it to the company. So it will be listed as part of the assets of the company in the company's balance sheet.
Okay. I think the same question is still being asked, but I think it's something that you have explained, that it's possible to have two salaries, that you can be employed by the government and still have another salary. But is that taxable income? Does it have any relief, or it's straight up paying?
No, if you look at iTax, you are only allowed to feel relief once. Okay, so you cannot have relief on both salaries. So the pay will be only on, the pay will be aggregated on the entire income, but the tax will be the relief will only be once. Even all the other expenses like mortgage interest, those reliefs are only going to be done once.
How long in advance can one pay payee?
So I learned today that KRA changed this in March. I think, if I'm not wrong, but I need to check, I think you can pay it in 1 to 3 months. It doesn't matter, because now, as long as you know that your payroll in your business it will not change. So you kind of know how much your tax obligation is. So that can be done. That means you can pay in advance in a month, 2 months. I don't know what the maximum is, but you can pay in advance, as from March of this year.
Is there any importance of withholding certificates?
Yes, withholding certificates are very important because they help you calculate how much advance tax has been paid. So let me give you an example. So if you're earning from 3 hospitals, all those hospitals, the minute they pay withholding tax on your behalf, KRA usually sends you an email with a withholding certificate to the email that you registered on iTax. So at the end of the year, what you should do is that you should print all those certificates, then just make sure that they're correct with the information on iTax. Then all that is a credit to you. So in other words, it's 5% that has been paid on your behalf. So KRA is giving you a chance to account for the extra 25% that should be paying. That's when now you deduct your expenses and things like that. So it's important to keep those withholding certificates.
The last question, do you have a quick recap on how one can leave or sell his stake in an LLC where there's no partnership agreement?
Now, an LLC is different from a partnership, because a partnership agreement is one that is used in partnerships, not in companies. The companies have memorandum of association and articles of association, and the Companies Act has described how the process of a director leaving. But and then also there's a process for partners leaving. So they're totally different.
So all that
a lawyer can help you. A lawyer can really help you on how to, if you want to leave a company, what is the process? How to have your, maybe sell your stake.
Okay, and that should have been captured at the very beginning.
Yes.
Okay. All right, I think that's the final question. We thank you very much, Dr. Wambugu. That was very informative and it leaves us with a lot to think about, and I'm sure we have learned a lot. So thank you everyone for attending our webinar. Another reminder that you are free to join the Kenya Association of Pediatric Dentists, open to all dentists, undergraduate students, and the pediatric dentists. CPD points will be generated and automatically fed into your ICPD portal. We usually try to work as fast as possible, so maybe by tomorrow or Saturday they should reflect. For those that haven't reflected, kindly contact me on my email or info@kapd.or.ke. This webinar will also be uploaded. It was streaming live on Facebook, so it will also still be present on Facebook on our group, the Kenya Association of Pediatric Dentists, but it will also be uploaded on our website, kapd.or.ke, where you'll be able to also find the other webinars that have been that have happened previously. So thank you, Dr. Wambugu. That was a great presentation. We hope to have you again.
Asante.
Yes, have a good evening, and we hope to see you same time next week, where we shall be having a talk on endodontics with Dr. Benjamin Simiyu, and this will be a collaboration with the Zimbabwe Dental Association. So we urge you to register early, and we don't get locked out like we did last week. Thank you once again, and everyone have a good evening.